Good morning from London. This is Bloomberg Markets Today. I'm Anna Edwards alongside Kriti Gupta and Tom Mackenzie. With the cash trade just an hour away, here's what you need to know. Indian stocks more than erased yesterday's gains as early vote counts signal a narrower than expected win for Prime Minister Modi. US Treasuries rise after soft manufacturing activity suggests a slowing economy fueling Fed rate cut bets. Meanwhile, ECB watchers are dialing back on interest rate cuts ahead of this week's decision, given sticky inflation and rapid wage growth in the euro area.
A quick check on the markets here, because futures are on the back foot. When you look at Eurostoxx 50 futures, they are down to the tune of about 0.2%. FTSE 100 futures down by about the same margin. Eurodollar seeing some strength here, a 109 handle on the currency, despite some of that weakness that Anna was just talking about. Brent crude tumbling below $80 a barrel. Markets today starts right now.
Good morning, everybody. It's just gone 7:01 here in London. There's plenty to talk about this morning when it comes to political risk. From India to Mexico, a bit of politics to talk about in the UK, perhaps not with the quite same risk in mind, but lots of political risk to talk about this morning. We work in... Good morning, Kriti. Good morning, Tom. We work into the conversation also. Plenty of other threads around the macro stuff. You know, I mentioned the soft ISM manufacturing data in the US, that bringing into the, firmer spotlight just how many rate cuts we expect, building on our expectations for rate cuts at the United States. Oil capitulating, you mentioned that, Kriti, at the start of the programme. Oil capitulating to that bearish view of the OPEC Plus narrative over the weekend. But I guess we start with India, Tom, and you've been tracking this over the last hour. The early market response to the counting that now takes place in this India election.
I mean, guess what? Exit polls are not always accurate, and that seems to be what's coming to the fore as they come through the counts. It's still, we need to put the caveat in place, it's still early days. They're still going through the count, but the early numbers seem to suggest that Modi is going to win, he's going to be victorious, but not have the kind of sizable majority. Markets have been pricing in 400 seats. It seems like he's going to be well short of that, at least on the current count. And so you're seeing a significant reversal then in terms of the upside that we saw yesterday on those exit polls yesterday. You've more than evaporated those gains, more than evaporated. You're seeing pressure on the rupee, pressure on bonds.
The world's largest democracy at the polls. I think what's really interesting here is the policies that he's standing for, right? This is a government and a term that's really vouching for a lot of infrastructure investment. I think the market reaction off the back of this is interesting. You talk about that majority in the looks of the parliament, basically, of India fading a little bit. The read-through into the likes of Adani, for example, and his mega empire, those stocks already plunging, ports down, the flagship and actual company enterprise down as well, over 15%. So there's a real infrastructure read-through. But it's a similar theme over in Mexico as well, where that congressional majority matters almost more than the leadership.
It's all about the extent of the leadership's ability to deliver on their agenda, isn't it? And it's a pro-markets agenda. Many people have interpreted from Modi, at least when it comes to reform of capital and labour and land and agriculture and the rest. Over in Mexico, it's a different story. And we saw the markets panic at the extent to which the new leader there will be able to deliver on her agenda.
Yeah, she's kind of viewed as the anti-market reform leader, and the fact is that it was largely expected that she would win. It was largely expected that even she would win in Congress as well, or the Chamber of Deputies, which is, again, the Mexican version of that. It also is significant that she is talking then about increasing the military, and now she doesn't have to rely on a coalition government to do it. That would have supported her anyway. But again, I'm going to bring it back to the market reaction here, because you are seeing one of the biggest carry trades in the markets right now, the Mexican peso against the Japanese yen, see its biggest weakness going all the way back to COVID.
And we had a reminder as well of potential challenges for Mexico November and post-November, with Biden signing that executive order in terms of the border and the question around immigration. And that reminds us that there's certainly a risk in terms of the relationship between the US and Mexico, whoever's the leader, and potential tariffs as well. In terms of a burgeoning manufacturing sector that's built out in Mexico and what the consequences could be there as well.
Where else might immigration play a key role in electoral decision-making coming up?
Can't think,
surely.
Anna.
Can't think. Should we get to the UK conversation? In the UK, Brexit cheerleader and populist Nigel Farage says he will run for Parliament. Days after ruling himself out, he'll stand as a candidate for the Reform UK party, as well as take over its leadership. Our UK correspondent Lizzie Burden is here with more. So he kept us waiting. Plenty of drama and theatre around the announcement yesterday, Lizzie. And he's changed his mind, basically, from 10 days ago. ago. He is going to run. He's not expecting to win, is he?
No, he'd made it seem as if he was more interested in getting Donald Trump back into the White House than in UK politics. But as soon as he tweeted yesterday that he was going to make an emergency announcement in the afternoon, there was just this whiff of despair around the Conservative Party. As you say, he's going to stand in Clacton. No one's expecting him to be the next Prime Minister of the United Kingdom, but the effect this will have on the general election is it's likely to suck Rishi Sunak more to the right. We've already seen announcements on pensions and national service aimed at older people who he clearly thinks reform might steal off him. Now we're likely to see even more of that, potentially a hardening of his stance on the European Convention of Human Rights. That's what we hear. Potentially also today an announcement on an annual cap on visas in an effort to stem migration, which has been something Nigel Farage has obviously campaigned on, not just recently, but through the Brexit campaign as well. Tonight we're going to have the first leadership debate between Rishi Sunak and Keir Starmer. Even before Nigel Farage's announcement, the polling suggested that Labour was on course for its biggest majority since, well, before Tony Blair, bigger than the landslide in 1997. It could be the worst defeat for the Conservatives since 1906. So things looking bleak for Rishi Sunak at this point.
Yeah, and of course, you know, as we mentioned, the Conservatives will say that the only poll that matters is the poll, of course, the vote on July the 4th. And they would also say they're rolling out measures to counter Nigel Farage and his Reform Party in terms of immigration and adjustments to the Equalities Act that came through yesterday as well. I wonder, though, in terms of the debate, who has more to lose, and we'll round out the picture with the different political voices. But whether or not Keir Starmer arguably has more to lose in this debate, given the poll lead, does he need to be involved in this debate? Rishi Sunak needs clearly to make up ground. That's what the polls suggest. How do you think about that dynamic?
Yeah, the classic analogy is carrying a Ming vase across a slippery floor. This is what was used in the 1997 election to say Labour's got this big poll lead, and it seems they do not want to squander it by announcing anything bold on, for example, economic policy. And so, actually, there's some interesting analysis from Bloomberg Economics this morning pointing out that, effectively, Labour presents itself as the party of change. It wants this to be an economic election, but when it comes to policies to grow the economy, they don't want to raise any of the main levers of tax, although we've not had any of the manifestos yet. But there doesn't seem to be that much difference in terms of what they would do to boost growth in the UK. And the Institute for Fiscal Studies says you can't just hope and pray for economic growth.
All right, Bloomberg's Lizzie Burden, we thank you so much for walking us through the political dynamics there we're watching in the UK election. It's interesting, though, from a market's perspective, when you look at least the kind of G10 trade at the moment in terms of FX around the elections that are coming up when it comes to the EU parliamentary elections, the UK election, even arguably the US election. There's kind of this element of almost complacency kind of standing on the background.
Yes.
Whereas if you look in the EM world, it's very much hop in on that trade because the data, at least in G10, is unclear.
It does seem as if there is more at stake in terms of ability to move and flex fiscal policy and flex policy broadly in some of these EM cases than there is, when you're talking about the United Kingdom, for example, a choice between two fairly centrist versions of what we've had in the past from these two major parties. It is interesting, though, to contrast what we might see at the ballot box, and we'll wait for July 4th, but certainly the latest MRP model, that's what Lizzie was citing, certainly suggesting, the Conservatives will really have a really, really bad time, down to, as she said, the worst since 1906 in terms of their performance. You contrast that really huge political news with an expectation in markets that nothing really changes.
Well, partly because of the fiscal constraints, partly because the polling has been pretty consistent. Has the polling gotten better? Many would argue in the industry that it has. But yes, it's the consistency of the polling and the fact that there are these fiscal constraints. It seems, in terms of the relatively benign reaction so far within markets to the UK. The data out of the US, switching focus to the US, and I wonder, and this is a question I put to Edmund Shing of BNP Paribas in Daybreak, was whether or not we're starting to see. Is this the benign slowdown in the US? So the manufacturing softening, we had the weakness in the consumer data out a few days ago. You put that together, is this the benign slowdown in the US economy that the Fed would hope to see, or is it something more concerning? Are we on the fringes of a recession in the US And I wonder where you both stand on that.
Oh, no, Tom. You use the R word. We're not allowed to say recession anymore in this environment. It's interesting when we're talking then about the bond reaction, because the 10-year is still at 440 off of that data. And to me, I think what's so important here is that the bond market and stock market are doing two completely different things. And usually they're on the same page, or at least they have been, I want to say, in the past couple of years. What happens in the bond market has a direct reflection on the stock market and vice versa. They're doing two different things. And I talk about that in the 10-year being literally on ice, because when you're talking about this economic data that's starting to show perhaps signs of weakness in the United States, or that consumer resilience breaking, I'm curious about why that's not being priced into the equity market, which is designed to price things in 6 to 9 months down the road, and yet they're acting like, and I say they as in the stock market, acting like this is far more reactive, and I think that's not something we usually see.
Is it just back to that simple expectation of rate cuts? And if the data is deteriorating, then you expect more rate cuts. I mean, that may be too simple in some senses. So one thing that stood out from the manufacturing ISM data to me, Tom, yesterday was the new orders sub-index, down at 45.4 versus 49 prior. I'm sure there's a lot of volatility in this, and it's only 1 month's worth of data and all of those normal caveats, but that's what certainly stood out to me. The other thing, market move, that really stood out to me was that big move in oil you referenced at the top of the programme. Really a big drop, and in fact we saw that continuing this morning with some substantial moves lower in the oil price. That bearish interpretation of what OPEC Plus did at the weekend gradually taking hold, it would seem, during
Well, it
the
was really
session.
fascinating because it didn't take place during our hours, did it? And it came in later. So what was the interpretation? What was the read-through? And it was a complicated decision. As Jemana, who was reporting on it for us out of Riyadh, was telling us accurately, it was one of the most complicated decisions that OPEC Plus have come to, because, of course, they're trying to assuage the pressure coming from the UAE and others. So they're going to be putting production some barrels back on the market towards the end of this year. But that was really pronounced, wasn't it, in terms of the oil market? So we'll watch the energy stocks here in the UK for any reaction to that.
Which have been leading, by the way, most of the stock rally that we saw, at least in yesterday's session. We should also mention, though, when you look at it from a kind of volatility perspective and a plumbing perspective, a lot of folks who have been traditionally exposed to oil as that hedge against the inflation story have actually pulled out. And the oil, looking to, relative to copper, gold, iron ore, for example, has been very, very low volatility. So I wonder if this is a little bit of a wake-up trade when it comes to the point that Anna was making.
Shall we talk about meme stocks?
As always, I'm ready.
Talking of wake-up trades.
Wake-up trades. Yes, talk us through, Kitty. I know this attracts your attention. GameStop, obviously the poster child for them. And I mean, I was off last week. I'm sure just before I went away, there was a whole load of excitement about
wake-up calls,
the return of quote-unquote Roaring Kitty, and whether he was back, and he was leaning forward, ready to get engaged in the markets. And now it seems, well, maybe he is. What's the latest?
Well, the theme for me in terms of all of this is market plumbing here, because we're having a lot of 2021 deja vu. Now, this is a story that we covered, of course, yesterday, that Roaring Kitty had posted on Reddit a $116 million bet, basically a screenshot of his trade on E-Trade, which is a online trading platform owned by Morgan Stanley as the parent company. Off the back of that, retail investors piling into the market, doubling those shares. And, of course, that trade that Roaring Kitty, otherwise known as Keith Gill, had put on, had options that allowed him to buy the stock at about $20. So there are now concerns coming up in the fallout of this massive rally that's saying, does that set himself up for kind of taking some profits based on his own move? At least that's a story that is being reported out of the Wall Street Journal.
And when does this get the eye of regulators? Because when one individual can move markets, well, at least move a bunch of meme stocks to that extent, does that surely that's on the radar of regulators? There's a challenge here.
Well, that's the concern coming off of Morgan Stanley here, that they're going to be potentially susceptible to enabling that kind of behavior. And again, according to the Wall Street Journal, it's this report that they may actually consider taking him off the platform. OK, we'll keep across the meme stock story for you, of course, because it is fascinating, the twists and turns. Here's what else to watch out for today. At 3 p.m. UK time, we're going to get the US factory orders and the JOLTS opening details as well. The numbers expected to soften a little. Bloomberg Economics has done some interesting analysis on this and what it tells us about how the US labour market is adjusting, and of course that coming ahead of non-farm payrolls on Friday. Later as well, we're going to get some earnings details coming through from CrowdStrike and HP as well, Hewlett-Packard, so that'll be interesting on the tech hardware front. And then we continue to wait out, of course, and keep an eye out for the India election results as those counts and the numbers continue to come through. We're going to watch the market moves, of course, which have been pronounced. And finally, we have the Berlin Aviation Summit today. We're going to look out for some lines from Safran, Airbus and Boeing CEOs, among others, after Airbus and the reports there suggesting that Airbus is in talks with China to sell around 100 wide-body jets. Kriti. Yeah, Anna, you actually brought this to our attention here, that this is going to be a really big issue. And I should mention that Boeing, at one point, a couple years ago, pre all these regulation issues with China, 12% of their revenue came from China. Now only it's something like 3%. So a lot going on in the aviation space. Guy Johnson, of course, was in Dubai covering that out of IATA for us as well. After the show, I'm headed off to Berlin. Super Return kicking off today. We're going to be talking a lot about private equity. We know those comments that Jamie Dimon had made a couple weeks ago saying that maybe the cracks in the economy are actually coming from private credit. They're coming from the private atmosphere, comparing it to the likes of mortgages, triggering, I think, the entire financial community when he said that. But we're going to go do some investigative reporting. Me and Danny Berger are going to be on the scene. This is the lineup that we have. Some really big investors coming out of Morgan Stanley, Goldman, etc. We're going to be talking about what that allocation looks like. Is PE oversaturated? Is this the next big move? Where are the cracks? We're going to find out.
Yeah, absolutely. And the rates environment will be running through all of that investigative reporting.
What is this, a $1.7 trillion market or something?
It's expected to be,
It's expected to be. Wow.
Enormous. We'll certainly be across that over the next couple of days. Coming up on the programme and in programming today, we'll be heading out to New Delhi as India counts the votes and markets react. Yesterday we got those exit polls. Did the markets jump on those two eagerly? Certainly, markets coming off this morning, erasing all of the gains in stocks yesterday over on the Nifty 50. Plus, as GameStop shares surge, we've talked about this, has the meme stock craze returned? We'll discuss. Up next, ECB watchers dial back rate cut bets. We will preview this week's rate decision. If you have any questions, please get in touch. IB plus BBTV Go is the function to use on your Bloomberg terminal. This is Bloomberg.
Europeans are heading to the polls to decide the makeup of the EU Parliament. On the ballot, economic growth and industrial policy, migration, and the geopolitical challenges facing the bloc. Stick with Bloomberg as we bring you the latest election updates from across the continent and analysis about what it means for the region and beyond. Tune in all week for continuing coverage leading up to the election results on June 10th on Bloomberg Television. Context changes everything.
The ECB kicks us off this week. We're expecting 25 basis points of rate cuts. And one of the reasons why they're first is because broadly the Eurozone has not been as resilient. We had almost a technical recession in Germany, which was saved by a data revision, so didn't quite get the technical recession. But look, it's been a softer economy. We think they go this week. The comments are going to be really interesting. But we think they could, in fact, do up to 4 rate cuts this year for a total of 100 basis points of cuts.
Sinead Cotton-Grant, CIO at BNY Mellon Wealth Management, speaking to Bloomberg with their view, that the ECB could go 4 times this year in terms of cuts. But set that against strong economic data in Europe and vocal ECB hawks. Both of those are pushing some economists and market watchers to dial back their expectations for further cuts this year. Let's get into a conversation now with Jumana Salaheen, Chief Economist and Head of Investment Strategy Group for Europe at Vanguard. Jumana, very nice to speak to you. Thank you so much for joining us. So let's get your expectations. We've got this piece out this morning that says a lot of people are having second thoughts about just how many cuts we get from the ECB because of the resilient data, because of the hawkish voices. But there we heard from Sinead talking about up to 4. Set your view in that context.
Yeah, thanks for having me, Anna. I think our view is that we're going to have 3 rate cuts this year, starting tomorrow in a couple of days on Thursday. And I think the reason for that really is, thinking about what's happening in Europe, we see growth below trend, although more recently it's been positive in Q1, and we do expect the end of stagnation, right? So that's one of the strap lines. We've had 5 quarters of weak growth, and now we're moving into a kind of more positive territory with growth. Inflation has been resilient. However, it's the inflation outlook that matters. And while the surprise was on services inflation, which has proved stickier, all other components are actually very much going back to trend. So the focus will be very much on the outlook. And given this picture, we see 3 rate cuts this year.
So are you not too concerned then about services sector wages, for example, which might be some people's area of focus, or commodities taking another leg higher? These things shouldn't worry the ECB too much.
These things, we have like a base case view, which is the most likely scenario. And under that, we expect it to be 3 cuts going back to target by the end of this year on the headline and core the very start of next year. So a very kind of positive picture. What you mentioned about commodity prices and services and wage growth in the service sector, we very much see those as risk factors. So we don't see them materializing. They're kind of more low probability events.
It feels like we've narrowly avoided recession in so much of the Eurozone. And the fact that recession, or at least the word recession, isn't even in the market narrative when it comes to Europe right now. Is that a blind spot? What do you think?
No. I think that obviously we had like a near recession at the end of last year. So the narrative we're running is that the worst is behind us in Europe. Rates went up into restrictive territory. The economy weakened, 0% growth rate in Q4. And so the worst is behind us. We didn't really have that recession, but that weakness came, and we will see, you know, that sort of working through other parts of the economy as we go forward.
Do you see China as a catalyst for Europe in the quarters ahead?
No, China's in a very different position. It's kind of been very weak. They've suffered from weak domestic demand. So to that extent, it's more a continuation of that weakness that we see in China, although the growth rate has been a little bit more optimistic in the recent months. But I would say the picture is kind of more a stagnation in China.
Where do you land on this, on the debate, the inflation debate? So the sequencing versus the Fed, the ECB and the Fed. Yep. There's the debate that if you go in Europe and the Fed isn't going, then there's an inflationary risk for the euro. And then there's the other debate, which is that the Fed holds is going to weaken demand anyway, so that's going to counter any inflation risks. And that debate seems to be unfolding within the ECB. Where do you land on that question?
I think where we land is we're kind of talking about policy divergence in terms of the policy actions, with the ECB going first and the Fed potentially going next year. So for the US, we have a story of deferred landing, if you like. So we do see a weakening in 2025, just to below trend. We're not talking about recession, but below trend growth in the US next year. And that will allow the Fed to bring back rates back to neutral. But the ECB goes first. And this divergence obviously constrains the extent to which the ECB can return to neutral.
We're talking a lot about monetary policy, and it feels like at the end of the day, the debt issues, the public debt issues are almost handcuffing the European economy. Pick any country you choose, whether it's the UK, France, I would argue even Germany as well, even Italy and Spain. I mean, pick your European country. To what extent is the market supposed to be sensitive to that? Or does it even matter in the context that it doesn't really give any government a ton of policy room?
That's a really great question. We have had a big focus on the last 2 years. It's all been about monetary policy tightening, restrictive, and now monetary policy cutting. I think what happened on the fiscal space, you're absolutely right. You know, Vanguard have spoken about this as well. You know, thinking about the long-term sustainability and thinking of the balance of the growth of the economy relative to interest rates, that R minus G debate that people talk about. We need to get that growth up to get the fiscal back on track.
So fiscal in focus. Going back to where we started the conversation, Jumana, is cutting into recovery, is that going to become something that is a difficult thing to explain for the ECB? Cutting rates as the economic situation improves?
I don't think so, because what we're doing is, you know, you're in restrictive territory, and if you keep rates high, even though the economy is recovering, that will kind of choke the recovery. So you kind of want everything to go back to trend, if you like. So as the economy returns to trend, we want interest rates to return to their neutral level where they neither stimulate or constrain the economy.
OK, Jumana, thank you very much. Thanks for joining us. Good to speak to you this morning. Jumana Salahin, Chief Economist and Head of Investment Strategy Group for Europe at Vanguard. We thank her very much for coming in to speak to us. Coming up on the programme, we'll get back to the political risk and how it's playing out in markets this morning. Indian stocks tumble as early vote counts point to a narrower than expected win for Narendra Modi. Narrower than we expected this time yesterday. And that seems to be enough to do the damage. Stocks really gained yesterday. Today, they erased more than they gained in yesterday's session. We're live in New Delhi. We'll get the latest for you. We'll deal with that political risk from wherever it comes from this week. This is Bloomberg.
Welcome back to Markets Today. We're about 30 minutes from the start of today's trade. You are seeing a little bit of a pullback when it comes to futures this morning in the Euro Stoxx 50 futures, but also when you look at FTSE 100 futures, perhaps a little bit of a hangover, perhaps just waiting for some of that data to come in. In the meantime, speaking of data, we are getting Swiss inflation coming out. Those May consumer prices hitting 0.3% on a month-over-month basis. The estimate was 0.3% as well. So bang on line with estimates on a year-over-year basis, coming in slightly softer, 1.2%. Again, the estimate was about 1.3%. Taking a look, though, at the market reaction, when you look at Euro Swissy, you're not seeing a ton of volatility. A quick spike up, but it looks like it's already been pared back. So it feels like the market's maybe initially, at least, shrugging their shoulders.
Yeah, it seems like overnight volatility obviously was a little elevated as we went into this number. There was seen as some risk. And ahead of this number, money markets were assigning a 50% chance, so really completely undecided as to whether we get another interest rate cut by the SNB, and that coming this week. And, of course, the SNB has gone early and gone out before the SNB has gone out before the ECB and been one of the trailblazers for the rate-cutting story. Yeah. But the inflation data that you just pointed to kind of explains that, doesn't it? And we talked about this at the time. There's a very different inflation dynamic going on in Switzerland.
It does, and the fact that they kind of front-run, to your point. But I'm also keeping an eye on it against some of the emerging market currencies as well, given that it's such a funding currency against the peso, against the Brazilian real, and even against those currencies, you're not seeing much movement, Tom.
Yeah, pairing it's dropped right now, 102 versus the euro dollar, with core in focus as well, year on year, 1.2%, slightly below the surveys for core in terms of inflation out of Switzerland. So if you see a relatively benign move around the assets of Switzerland, it's a very different story around the assets of India, because Indian stocks and bonds slumping as early vote counts suggest a narrower victory than expected for Prime Minister Narendra Modi. Let's get the details then and bring in Bloomberg's South Asia economy editor, Ruchi Bhatia, who's on the ground for us. Ruchi, what are you seeing in terms of the vote count numbers? This has been a surprise, certainly a surprise for the markets, and the reaction across the equity space, bonds and the rupee, has been pronounced so far in the last few hours at least. What are you watching for in terms of the count going forward?
Oh, absolutely a surprise coming in. It does look like that the election results will not be a one-way street as it was being earlier predicted in the exit polls. The exit polls showed that perhaps Prime Minister Narendra Modi would get a supermajority, but the election results today are looking very, very different. In fact, it shows that the opposition parties have been able to give a very tight fight to the ruling Bharatiya Janata Party. It does look like, with the numbers that we have so far with the early leads, that the BJP will be forming the government for the third time over, but they will need the support of the allies, which means that some of the issues, local issues like high unemployment, high inflation, seem to have resonated with the Indian voters, and perhaps that's the reason that they seemed fairly miffed with Prime Minister Narendra Modi, and that is the reason that he's not gotten a supermajority as his party was anticipating earlier. Let me also tell our viewers that 272 is the halfway mark. The BJP is still close to that mark, but they will need support of their allies.
OK, so voters are more miffed than had been anticipated, perhaps. And you're right to actually, yes, of course, to point out to the importance of 272. Still watching that number. We thought we'd be thinking about 300 or 400, but we're certainly focused on that 272 number as the count continues. What's made this tighter, then, than analysts and psephologists had forecast? Why was I suppose the question also is, why was the polling wrong? But what's made this tighter?
As I said, perhaps the local issues made it tighter. The fact that, India is still, it has a large young population, but the young population does not have enough jobs. Despite the 8% odd growth that we are seeing in the country, unemployment is fairly high. And those are the issues that seem to have, they were being talked about during this 6-week-long election process. What also worked for the opposition parties, let me tell you, is the fact that they decided to not contest against each other. They decided to fight the Modi juggernaut. They decided to fight against him not getting that 400 magical mark, and that is the reason that we've seen that the the fight looks like a mostly close contest in many seats, and that is the reason that we're seeing that the results are looking far from what we saw yesterday in the exit polls.
So, Ruchi, in terms of actual reform, in terms of actual policy agenda, how does this show up? Does this impact any infrastructure plans?
Not so much the infrastructure plans, because the analysts and economists that we've been speaking to, they do tell us that the broad contours of Modi's policies will still continue to be the same. He will, push his focus towards boosting the country's infrastructure. But as far as pushing critical reforms like labor, land, farm are concerned, that is where he will need more political capital. The jury is still out as to what the final numbers or the final tally will look like. But to push through critical reforms will now become very difficult for Prime Minister Narendra Modi. Even when he had, very high numbers in the last elections, he was not able to push through critical reforms like land, labor, and farm sector reforms. And those kind of issues will continue to exist even in the third term.
Yeah, the agriculture reforms, of course, something that is almost going global. You see that in the Canada read-through as well. Bloomberg South Asia economy editor Ruchi Bhatia, we thank you so much for that crucial context. Sticking with the geopolitical story, the EU's landmark climate policy could be under threat after this week's European elections. Back in 2020, the bloc adopted the Green Deal, a commitment to become carbon neutral by 2050. But with the energy crisis hitting voters' wallets, that ambition could be difficult to achieve. Let's bring in Bloomberg climate and energy reporter Eva Krukowska. Eva, a pleasure to have you on the program. The backdrop very different to 2019's elections. Are we seeing backlash against the EU's climate agenda?
Yes, this is a backlash. And when I speak to policymakers in Brussels, I often hear everything has changed but the urgency of climate change. The problem is that when the Green Deal was presented, we had a wonderful state of the economy. Interest rates were low. There were no bigger concerns. And then we had the pandemic, the lockdowns, then we had the war in Ukraine, a cut in Russian fuel supplies, in natural gas. Energy prices skyrocketed. And even though they eased from the all-time highs, they are still relatively high, above the levels seen before the war, and clearly much higher than in China or the US. So when voters in Europe still think that climate change is important and it's one of the biggest problems in the world, they are not really willing to pay the bill. And with increasing costs of living, this is a huge challenge. That is why we are seeing protests. In fact, as we speak, farmers are gathering in Brussels for yet another round of what may turn out to be violent protests. The whole area around the Commission headquarters in Brussels is fenced off. There are dozens of policemen, and this doesn't look good.
Interesting. And the Gilets jaunes protests in France a few years back seem to be maybe a canary in the coal mine in terms of voter reaction to some of these policies. So if voters in Europe do turn their backs on the green agenda, and it's a deal that's the most, and the plan and the targets, the most ambitious in the world from the EU, what does it mean for that Green Deal?
It means that implementing the Green Deal, the move from policy papers to having the reforms implemented and affecting corporate decisions and lifestyles will be much more difficult to achieve. Because if you look at it from the perspective of policymakers, they made a commitment. They agreed to the targets. They agreed to a huge set of reforms. Now, the work belongs to the governments and to the European Parliament as well, because they will have to decide how to implement all those regulations, how to turn them into real life, how to tell people that they have to share the bill before energy prices fall on the rollout of renewable energy. This is going to be a very difficult task, and the strengthening far-right groups in the European Parliament may make it even more difficult, because for them, criticizing all the Green Deal legislation is a low-hanging fruit.
OK, Bloomberg's Eva Krukowska, thank you very much indeed on the potential electoral impact on Europe's Green Deal. Coming up, stocks to watch, including Maersk, the bellwether for global trade, raising its profit forecast as Red Sea disruption boosts shipping rates. Details next. This is Bloomberg.
Welcome back to Markets Today. We are 17 minutes, if I can do the quick maths, away from the start of the European equity trading day. That looks as if it could be kind of negative. We actually managed to turn a corner during the US session to get back into the green just towards the end of the session on the S&P. And that was really a battle between the commodity stocks that were a bit lower and the tech stocks that were rallying later in the day. But that not set to have too much of an outsized influence on what happens here in Europe, it would seem. And European expectations are a little weaker. Joining us now to talk about the markets, our Markets Live executive editor, Mark Cudmore. Mark, good morning to you. We should talk about India because I don't know whether it's fair to look at the performance yesterday and today in a discrete sense as two separate events, whether we should really sort of put them together. But we're still in that working out what happened with the election phase. Yesterday stocks went up. Today they drop in fine fashion.
Yeah, absolutely. I think you're right that we have to view it all as kind of one session on the week, and it's still evolving. We're still, waiting for a final confirmation of how all the results will break down. But I have to say, this price action is very worrying for India. And it is fair that we did acknowledge this. Ven Ram did an excellent piece yesterday on the exit polls that Indian stocks were priced for perfection, were priced extremely optimistically, and therefore it was hard to see upside in the short term. And I think that given the technical damage out there, there could be more pain ahead on a relative basis for Indian stocks for some time to come. Look, the long-term structural story is wonderful for India. It is a great growth story, and it's real growth and nominal growth. The demographics are wonderful. There is likely to be at least policy continuity, even if it's not the majority that Modi wanted. And it's a good story overall, but it's a story that's been so overpriced. So I think we could have several weeks of disappointment for Indian stocks, even if the long-term story is valid. I'm not sure if bonds suffer for long because of the Indian bond inclusion, the JP Morgan EM index. I think Indian bonds will probably do okay, and I think the Indian rupee will stay stable. But I think it's equities where there might be some sustained pain for a little while.
OK, so we'll keep watching that one. Of course, emerging market risk, something we'll continue to talk about. More on that in a moment. But I just wanted to get to the wider market stories. And it looks as if the European session could be a little bit softer, looking at that US data from yesterday, that ISM print perhaps. But also we've got commodities under pressure. And yesterday, after the start of the European session, it seemed that the market came round to this sort of bearish interpretation of what OPEC Plus did at the weekend.
Yeah, and I think this kind of feeds into, there's a little bit of a new disinflationary narrative that kind of creeping back in again, particularly in the US, this idea that, hey, growth's slowing down. The consumer is weak in the US. Growth's not as strong as we wanted. That might let the Fed justify the rate cut. Also, see if the jobs report comes through this week. So I think that's more interesting. The commodities coming lower, particularly oil prices coming lower, help that narrative a little bit and will help bonds do okay for a while.
All right, Mark, don't go anywhere, because as we're talking about that election risk and, of course, the commodity risk, there's another election that's, of course, caught my eye, and that, of course, is what's happening over in Mexico. There's a chart that I want to bring to our audience's attention. This is specifically on the Mexican peso against the Japanese yen. Now, the reason I picked this currency pair is because we know that the Mexican peso, the Brazilian real, have been the go-to kind of EM exposure trades, specifically for investors in the U.S. But if you're a non-EM investor and you want some of that exposure, this is usually the currency pair you go to over, say, the Japanese yen or the Swiss franc as kind of a funding currency, really to capture that yield that is perhaps not offered in other parts of this market. And this is, by the way, the biggest drop that you are seeing going all the way back to COVID. That seems to be the theme that you are seeing in a lot of the asset price moves overnight. Mark, I want to bring you back in the conversation here. When we talk about this carry trade, how much or to what extent do some of this geopolitical risk get in the way of that?
In the short term, they're very much getting in the way. I do think they can continue. I think the fundamentals for the yen remain so negative. As you know, I've been bearish for yen for the last few years, and I remain very bearish. And I think, therefore, it's not just a carry story. The yen should continue to weaken. And the Swiss franc probably has, an ongoing bearish bias, maybe not so much in the short term, but it has a general backdrop there that facilitate the carry trade. Now, what currencies do you want to go long through the carry? Mexican peso has been the darling of the last couple of years, has been favoured. But since last month, it did seem overstretched, given that we not only had the Mexico election, which we're going on this week, but we have the US election later on this year. So I think that people will go back into the carry trade despite the disruption this week. they may not choose the Mexican peso as their favoured vehicle going forward. I think that there are interesting options coming up in EMEA. I think, for example, Hungarian forint is becoming an interesting option. I think possibly after some of the election turmoil, I think that there might be entry opportunities for things like the Indian rupee. Indonesian rupiah is another one that's less carry, but it's a bit more stable. And if South Africa might provide election, once we get a little bit of election uncertainty and it sells off a bit, there might be opportunities to enter there. So I think there are becoming better options than Mexico that was the standout trade of the last couple of years.
Really interesting. Mark, when it comes to the data out of the US, where do you stand in terms of the risks around the US economy right now? So manufacturing coming in much softer than expected. The consumer's looking a little bit more fragile. We've got non-farm payrolls, of course, later this week. Is this a benign slowdown or something uglier in the US?
At the moment, I think it's very much a benign slowdown. You know, Tom, I stand in the camp that I don't really believe a soft landing. I believe that you either get a hard landing or no landing. And it looks like a soft landing on the way to a hard landing. But I'm not particularly bearish in the US economy. I think that growth is not brilliant. But I think that the ISM indicators, Simon Flint, our colleague, has done an excellent piece showing that there's just been a growing bias in the ISM indicators that show that it's not been a very valid guide for the hard indicators. And therefore, yesterday's depressing print won't sustain that kind of negativity. So sure, US growth may not be as good as we thought it was a month or two ago, but it doesn't seem to be going off a cliff yet, and I don't think the ISM is showing that. What I am worried about is if that we continue to get sticky inflation and growth continues to slow further, that might be quite a messy setup. But for now, I guess, I remain probably pretty optimistic on the US economy relative to how some people are starting to talk.
Mark, as we continue our tour around the world, a quick comment here on Eurodollar. I was surprised to wake up this morning and see it at 109. What justifies the strength in that currency?
I think this is a convergence trade. I think we're getting that idea of that, hey, so for the last 5-6 months, we've been trading the idea, or 5 months, we've been trading the idea that US won't be able to cut as much as was priced. A crazy amount was priced. So we priced out all those rate cuts, and I thought that theme had more to go. But in fact, what we've seen in the last week is this slower US economic growth and the idea that, hey, maybe if unemployment gets worse, maybe the Fed might be cutting actually sooner than we thought after all. In the meantime, about a month ago, European pessimism kind of reached an extreme, and therefore we're seeing a slight improvement on the European growth story. It's not a particularly positive one, but it's an improvement from where we were thinking, and inflation's proving stickier there. So I think we're seeing a little bit of a convergence. The ECB may not be suddenly following their rate cut this week with loads of other rate cuts this year. Meanwhile, the Fed may get away with actually cutting this year once or twice after all. We'll have to see. So I think that ultimately we're starting to reconverge. They may do roughly the same amount on the monetary policy side. And if that's that narrative probably has a little bit more legs, and Eurodollar probably has more upside as a result.
A lot to digest there and a lot of cross currents to navigate. Bloomberg Markets Live executive editor Mark Cudmore joining us this morning. We thank you so much. You can get more from him and the team. Up-to-date analysis and insight. Just type in MLIV GO on your Bloomberg terminal. Let's go from the macro to the micro. Joe Easton standing by with our stocks to watch. Joe?
Morning, Kriti. So we're watching Maersk today after the shipping company raised its forecast for profit for the full year as it benefits from the disruption in the Red Sea due to a Houthi rebel attacks. They now expect their profit for the full year to potentially hit €9 billion, up from a previous guidance of 6. Now, we've brought up the shipping rates because this really does give us a good picture on what happened given those attacks in the Red Sea, spurring that surge in global freight rates across a period of a couple of months. And we've actually seen that priced into Maersk stock already to some extent. That stock has had a bit of a rebound from some recent lows. There we are on the screen. So we've come up pretty much back to the level that we were in December when those attacks started, as people are predicting these rates to benefit the company. However, given that is priced in, we are seeing some actually pretty downbeat commentary from analysts. Here's one from Morgan Stanley that jumped out to me, saying that Maersk is potentially a value trap as the market is already derating these earnings guidance upgrades. As we can see from the screen here, 10 sells outweighing the buys on Maersk. So as I say, potentially this is going to be priced in, but we are seeing some small gains on the Tradegate exchange for this one this morning. Then we're also looking at Deutsche Telekom today, the German government offloading €2.5 billion worth of stock. This is around a 2% stake in the company. They say they will use it to reinvest in Germany's train sector and the rail business, revamping some of their rail sector industries as well, and that is going to be a bit of a boost for some of those commuters, unlike here in the UK, perhaps. Here's the Deutsche Telekom stock on the screen. We can see it actually outperforming the Stock 600 Telecom Index, and potentially a pretty good time to be getting out of some of that stock for the government there. Then finally, we've got some breaking news on Airbus. Now, the company is in talks with Chinese airlines, potentially, who are going to buy around 100 jets, the A330. This follows a meeting between Xi Jinping and France's Emmanuel Macron recently. Now, Airbus does benefit from the fact that it has factories over in China, and also, of course, Boeing is having these supply issues, and it does feed into the case of Airbus outperforming Boeing, as we can see on the screen here, the classic rivalry. Airbus doing pretty well, up almost 35% over a one-year. Boeing weighed down by those production issues. Keep an eye on Airbus over in France today.
OK, equities reporter Joe Easton, thank you very much indeed. Yeah, Airbus called higher on the back of that potential deal, it seems, the sale of 100 wide-body jets to China. The conversations between Macron and Xi Jinping apparently paying off. Joe, thank you very much indeed. We'll have Joe back on, of course, in the next 10 minutes or so to check in on the market moves just after 8 o'clock. I can't take my eyes off the Indian markets, though. Currently, the Nifty 50 down almost 8%, the Sensex down 7.5%.
Yeah, quite incredible. You have to go back to, 2020 to find times where we dropped this much on that particular index. So certainly emerging market political risk and perhaps on a sentiment level finding its way to some degree into European equity market sentiment.
Yeah, it's interesting that we're talking about this in context of the moves being similar to COVID 2020, the COVID crash. I was going to say COVID-19. I think what's important here as well is that, and Mark mentioned it, he said price to perfection on certain people were looking at the Indian elections, price to perfection. And I think that brings about a lot of questions from a macro standpoint of dislocations in the market, plumbing in the market, how much liquidity even is there in the Indian rupee or the Mexican peso, et cetera.
And another dynamic we'd just throw in is the weakness we've seen in commodity prices over the last 24 hours, down at 77.64 on Brent. Some of that we factored in yesterday. Energy stocks were weak in yesterday's session here in Europe, but we'll keep an eye on those today as well. Coming up, we'll bring you the market open. Futures are pointing lower. This is Bloomberg.
Welcome back to Markets Today. Just a few minutes to go until the start of cash equity trading. Futures a little bit on their back foot here, but not by a major margin, down about 0.3% on the Euro Stoxx 50. When we're talking about those individual movers, there's a couple of stocks we have our eye on. Joe was just talking about it when it comes to Maersk weighing up its full-year guidance, talking about the fact that they're actually more confident about some of the shipping rates, but not on necessarily positive news for the global economy.
It's a bad news is good news for Maersk story, isn't it? It's because of disruption continuing in the Red Sea and the way that pushes up the freight rates that they're able to charge, basically.
Bad news is good news for Maersk, is bad news for the rest of us in terms of inflation. And it's quite a significant upgrade coming through from Maersk in terms of those, in terms of the expectations around rates and what it means for their profit and revenues for the year. So really, really an interesting story around Maersk and the broader tell on the inflation risks, as that Red Sea situation, of course, has not been resolved.
Yeah, the press release is interesting. He also talked about congestion in ports as if it was a positive thing, which is not necessarily, to your point, a positive thing in the rest of the world. And the context is important, remember, because just 2 quarters ago, they suspended their buybacks and their dividends. So if they're increasing their guidance, do they reinstate some of that? So that's one company that we're watching. Another that I've got my eye on, KKR and EQT, shortlisted for Cellnex's Polish unit. This is a Spanish company. They have telecom units around the world, but because of some kind of fundraising issues, they've been talking about spinning off their Polish unit for a while. Bloomberg had reported this potential stake back in February, and it looks like Expansion, which I believe is a newspaper, is now confirming that.
OK, so that's certainly something to focus on, along with Airbus, and more on that in a moment, perhaps. The overall futures picture then does look weak, to your point, Kriti, not by a huge margin, but down 0.3% or so on Euro Stoxx 50 futures, 10 seconds to the start of Tuesday's trading session. Yesterday, global stock market sentiment buoyed by India. Certainly that is not the case today. The Indian market under pressure, falling as much as 8% this morning. And so we keep that in mind as we wait for the start of European trading. Not perhaps direct read across, but in terms of sentiment, they could make its way through to us here in Europe. In terms of the start of the European trading session, then we do have a little bit of weakness, down 0.1% on the Stoxx 600. The FTSE down on par with that. The Xetra DAX pretty stable, in fact. So it's a sluggish start to the trading trading day here in Europe.
It is, and we should talk about just some of the early movers. We're talking a lot about the commodity story and the read-through that we're going to see, especially as Brent crude drops now below the $80 a barrel line. Well, your biggest index weight, at least on the Stock 600, is Shell, Total, BP as well. So already, right from the get-go, you're seeing commodities on the back foot.
Yeah, BP, one of the biggest droppers right now, down 1.8%. Ocado, a very different space, of course, in terms of retail. That is also falling around 3%. We're looking, of course, at the airlines, and particularly Airbus, on that news that they may be selling, of course, 100 planes to China. And across your sectors then, bottom of the list then, in the energy story then, down as a sector 1.2%. Construction and materials also taking a bit of a hit, down 0.6%. So far, just one sector in the green, in positive territory, which is personal care and products, up 0.2%. As you see again across the benchmark here in Europe, Stock 600 down 0.2%.
Yeah, I'm glad we've mentioned what happened with oil prices yesterday a few times, and the potential for read across into the energy stocks once again today, because as you say, Tom, that is the worst performing sector, down by over 1.2%. So there is considerable downside there. But all of these sectors really, apart from that one, personal consumer goods and grocery stores, are trading weaker today, Kriti. It's pretty broad-based, this negativity.
It is. Some of the positivity, though, into the outliers, into that consumer story that you're talking about, Unilever and Nestle higher. And we should mention that Nestle was actually one of the leaders yesterday as well. So you are seeing something going on with Nestle that we're keeping an eye on. I wonder if that's simply just a large cap, small cap kind of story. Maersk as well, we should point out, higher by 3% after reinstating that guidance and actually boosting their full year guidance as well. So that's something that we're going to be keeping a very close eye on. When we're talking about investing, however, in this equity market, lots of different views about whether this is a buy opportunity or a sell opportunity. We asked that very question to Ben Ritchie, the head of developed markets over at Aberdeen. Take a listen to what he had to say.
It's always about the stock level opportunities. I think the connection between macro and micro tends to be pretty loose at the best of times. You know, the classic would be China, phenomenal economic performance for many years, terrible stock market performance. So I wouldn't connect UK macro performance with UK micro stock performance, particularly given the exposure to overseas markets, which is 75% of revenues. But there are still some really attractive opportunities within the UK. And I think it's just saying don't completely overlook a market just because you don't like the macroeconomic picture.
Ben Ritchie there, the head of developed market equities over Aberdeen, speaking to us yesterday. Let's get another perspective here. Helen Jewell, CIO for fundamental equities over at BlackRock, joins us this morning. A pleasure to have you on the program. When you watch in the market environment that we're in this morning, where it kind of feels like there isn't a ton going on the macro level when it comes to European indexes, simply because everyone's getting all of their geopolitical news and trying to digest it, is there some sort of sentiment that what's going on in, say, the Indian stock market or the Chinese stock market is setting the tone for this region? How do you view the read across?
Great to be here, as always. I think when you're looking at the region, we are in a little bit of a wait and see, particularly till Thursday. And on Thursday, it's not about the rate cut. I think that's a foregone conclusion. It's about the narrative about what happens after that. If we are in a one and done, or if there are going to be more cuts to come following this week's cut. That is a really, really interesting moment for European markets. If we see one cut, and then there is indications that there will be a lot more coming through this year, I think the European market, it's not really going to happen quite so much what's happened in India and what's happened in Indian elections. The focus is very, very much going to be on the region. If it is much more of a, like, we're done one, now we're back in that wait-and-see mode, then I think probably we'll go back to markets like we're seeing today. And what we're seeing, and I'm kind of listening to some of your comments there on some of these large-cap names, I think it's actually the defensive ballast that have not performed particularly well over the last 12 months. People are going back into those just to provide a ballast to portfolios. But Thursday is going to be absolutely critical, not because of the cut, I think that's a foregone conclusion, but because of the narrative that comes after that.
In terms of that sectoral bias that you're talking about, the defense story, we know what defensive positioning looks like in traditional terms, but I'm curious, in this environment, when we're talking about a potential uptick in inflation or parts of Europe that are dealing with inflation, what sectors are included in that defensive overlap? Is it still healthcare, or are we talking about a consumer hedge, for example, for inflation, or is it still the mega cap tech? How do you view that?
No, I mean, I think it's all of them, but the one I'm particularly interested in at the moment is that consumer staples. You know, the consumer staples are often overlooked. They're not maybe as interesting as some of the other stocks. They don't necessarily get the benefit from those structural AI kind of trends.
But when you look at what they do, they give you exactly what you want from defensive names. They give you a strong return, not hugely exciting, but regular, decent returns. And they have really not particularly performed well over the last 12 months. So from a valuation perspective, they're looking interesting as well. So consumer staples, they've been really overlooked. They've not really had much of a story attached to them. For me, that's still where your traditional defensive ballast is. But there are other areas as well. Utilities as well is always an area that you should always think about in these kind of markets.
Well, to that point, I mean, the rate-sensitive sectors, to what extent are they positioned, or at least are you able to position around rate-sensitive sectors as we get to a point where the ECB cuts and possibly the BOE maybe in August, maybe in September? To what extent do you want to be thinking about positioning to rate-sensitive parts of this market?
I think you really want to. That's exactly where you want to be thinking right now, because the valuations in those sectors don't look particularly crazy. So some of them have performed well. Utilities has not done particularly well, but other parts of that basket have done better. But real estate is another area that could be really interesting. And I think putting that ballast and putting that barbell around your portfolio is a really sensible thing to do, unless on Thursday the ECB comes out and says we have a lot more rate cuts to come. At that point, I would lean in much more to the cyclicals, the beta names, because I think if that is what you see, that is going to be a real rocket launch for the economy, particularly the small caps. And the small caps still is where you see real valuation discrepancies. So if that's what the ECB do come and say on Thursday, Tom, I would be really leaning into those kind of names.
Do you have the confidence to lean into UK small caps at this point?
Yes. I mean, it was interesting listening to the comments just there about the macro in the UK. It's really important to distinguish between the FTSE 100 and the FTSE 250. Yeah. The 100 is very much about the global markets and those value stocks within it. But the 250, the small caps, absolutely be leading into those names if we do see the rocket launch. The big risk to those names is, of course, you've got the UK election coming up. But the UK election, the key issue there would be any kind of hung parliament. A UK election that gives you any kind of decisiveness, no matter where that decisiveness is, again, I think will really bring interest back to the UK. And we're seeing that at the moment. You know, clients are really asking us about the UK a lot more than they have before. And often you see that, you know, we saw that with Europe last year, a lot of questions earlier this year. And finally, we're seeing the flows come through to Europe. And I think that's what you see or will be seeing in the UK as well.
Helen, good morning to you. Is there any way that if we do get what polls have suggested in the UK, and that they're not a forecast, they're not a predictor, but they're a good indicator of where sentiment is right now. If we do see what the polls suggest, is that risk positive, that kind of certainty about policy outcome? Because a lot of people focus on the lack of difference between the sort of two policy proposals in a market relevant sense. Yeah. Whereas you're painting a picture of it mattering if they have a kind of decisive victory.
Completely agree, Anna. I think because the policies aren't hugely different, it's in terms of spend and where that spend might go, it's about that certainty. It's about that certainty and then looking for growth coming into the UK as a result of that. So I think certainty is what the market always likes. And again, you saw that yesterday with India. You know, the market reacted well because it thought it had certainty. Then there perhaps is a little bit more uncertainty about what the actual outcome might be, and you see the market reacting to that. So when it comes to these kind of outcomes, certainty is one of the key things, unless you have policy differences about where spend might look. But in the absence of that, certainty is key. OK,
so certainty is key. It's interesting because sometimes in the US context, we talk about, government getting out of the way. And sometimes when it's difficult to do things on Capitol Hill, markets kind of like that because they sense less intervention. But we've got a little way to go until November. Yes, so, we've got plenty of time to talk about that. Back to the European story, because I think it's very interesting what you're saying about thinking about what kind of guidance we get from the ECB. How do you think the ECB sells this idea that they're going to start cutting rates, but don't worry, the economy's not doing too badly. If anything, the economy is recovering. How do they get that messaging across? Yeah,
I think this is the tightrope that they have now got to really tread very, very finely. And I think this is why I'm probably more on the side of there'll be one cut, maybe two this year. But I think the kind of feeling that there will be four is probably a little bit over-optimistic, shall we say, because I think it's unlikely that the ECB, and inflation is not 100% under control right now. They will want to be super clear that these cuts are because this is part of a very clear, consistent plan and nothing to do with any recessionary concerns. So I think getting that messaging right will be absolutely critical. I think, to be fair, they've done a really, really good job so far. But that's why I'm probably more on the side of erring on the caution caution of fewer cuts rather than more, to be honest, Anna, because I think they won't want to kind of send any kind of sentiment that there is any recessionary concerns around this.
When we're talking about the sector perspective, I'm circling it back here in terms of valuing in the context of rate cuts, how to really look outside of the tech space for value in some of these sectors. You mentioned consumer at the beginning of this segment. I should point out, as we monitor the read-through from the Indian sell-off that we're getting, and don't worry, I won't ask you about the Indian market, don't panic, but one of the only stocks, two of the three only stocks in the green are Nestle and Unilever, the Indian branches of those, which I thought was pretty interesting, and a really broad sell-off. When it comes to the consumer story, though, how do you value that? What do you look for in the valuation there?
So what it again goes back to is this point of certainty. I mean, whenever we're looking at stocks, there are two things at play. You've got where the earnings are going, you've got where the growth is going. So that's the kind of top line. And then you've got the multiple. And the multiple is all down to the certainty and the risk associated around that. So you're looking at the interplay of those two things. And I think what's really interesting in those consumer names is both of those look pretty stable at the moment. So you're not having to put too much in terms of play around that. Now, as active stock pickers, again, when we're really leaning into things, that's not necessarily where we lean into. We often lean into the more cyclical names. We lean into the luxury goods space. We lean, of course, into the tech story, and where you see those structural gains. Beneficiaries of the transition as well is somewhere that we really see a lot more growth. But when you're trying to ballast a portfolio in these kind of markets, what that gives you, again, is that important word of certainty. And that's what we're really trading off in those kind of names.
I'm saying on...
No, go ahead.
On the energy front, Brent at $77 a barrel, WTI $73, so down 1.5% on WTI in the session today. Is there certainty in the outlook for oil? How do you play the energy story?
So with energy, I think it's... we've talked a lot about range bound, and I think most of the commentators who come here talk about that famous range bound of 70 to 90 that hasn't let us down much so far, and I still think that is where oil will be sitting. And that means that when we're looking at the energy story, what it really comes down to is, again, what it provides from the market and your portfolio perspective. Energy names give you value exposure, and they give you strong returns. Double-digit returns to shareholders. So in portfolios where maybe we haven't got absolutely clarity of where the markets are going to sit, they provide a really nice ballast in portfolios. So at the moment, it's not necessarily about a play on oil prices. What it is portfolio and portfolio construction for those names.
Thanks so much, Helen. Jewell, very nice to speak to you. Helen Jewell, CIO for Fundamental Equities EMEA at BlackRock. Thank you for joining us. Let's get to some of the individual stocks on the move. Joe Easton has a briefing for us. Joe.
So we are seeing a gain in Maersk at the open, but only are up around 0.9% at the moment. At the open of trading, it was up almost 2%, and that was the best performing stock on the entire stock 600 in the opening moments of trade, just showing you there aren't too many stocks doing well this morning. We are seeing a bit of a read-through, though, in some Maersk peers, including Hapag-Lloyd, DSV over in Copenhagen, and also Kuehne and Nagel, which is over in Switzerland as well. So the shipping firms getting a boost, but not as much as you might expect, given Maersk has upped their profit forecast by around $3 billion. A lot of that already priced in, as we said earlier. Then, in terms of the oil impact, just wanted to bring up a couple of oil stocks because we are seeing that Brent crude price decline, as you guys were discussing there. Brent down 4% since yesterday afternoon. We're seeing Shell, Total Energies both lower today, and some very small gains in the airline stocks, given potentially that the oil price weakening is beneficial for the fuel outlook for those companies. So we can see the effect of the oil price in these stocks this morning. We'll also look at Deutsche Telekom, a big share sale from the government. They're going to plough into the railroad sector. We're seeing Deutsche Telekom coming down to 2.3%. Actually, that price there is exactly the price that they've sold the stock at today. So we can see it just coming down to that level. Quite interesting on that one for Deutsche Telekom, seeing a decline over there. A couple of consumer stocks. You mentioned Unilever earlier in the show. Now the CEO is presenting at a Deutsche Bank conference today, a Deutsche Bank consumer conference. We're going to keep an eye out for comments potentially on the ice cream spin-off and the broader market, given we saw some commentary from Nestle, the big rival, last week around demand. And note Ocado down. We are expecting it to drop out of the FTSE 100 later today when we get the reshuffle confirmed by FTSE. It's down 1.3%. It's had a bit of a decline, so will be demoted to the FTSE 250 later today. Then in terms of your morning calls, one over in the auto space, Continental. This one is a downgrade over at Bernstein following weak earnings for the tyre maker. They go underperform. price target 54. So we are seeing some downside in that, down 0.9% today. And finally, one more positive one, Klépierre. This one is a double upgrade, much more positive. City likes this. They say the rental market in France isn't as bad as people think it is, and that stock should start gaining, they reckon. 32.50 price target, lots of upside. Klépierre is up in Paris this morning.
Joe, thank you so much. Joe Eason with a briefing on some of the stocks on the move this morning here in Europe. Let's go back to India, though, where stocks certainly on the move. The Nifty 50 under pressure, down by as much as 8% in session today. Really interesting, guys, on the T-Live blog that's running here. Our colleagues over in Asia running this blog, talking about all of the election results, but what it means for markets, what it means for the Indian economy. They're flagging what happens if we get to a 10% drop. If that happens before 1 o'clock, we'd end up with a trading halt for 45 minutes and all kinds of other permutations around whether it's a 10% fall, what time of day it happens. But be aware of that we could end up in that kind of situation if this negativity continues.
Yeah, absolutely. And the Sensex down in similar territory, down 6%. The rupee under pressure, bonds, Indian bonds under pressure. Interestingly, speaking to BNP Paribas Wealth Management CIO Edmund Shing earlier, he said, look, this is nonsense, what we're saying. Ignore it. It's ridiculous, the moves in Indian equities. He says the long-term story is still there, but the volatility says you need to look through it. But it does remind us of the, we've been talking about this, the political risk now, more broadly, globally, around the equity markets.
And I think it's really important for a global audience to remember that this is a country, it's a largest democracy in the world. It is mobilizing a population of 1.3 billion people, which is why that competition thread with China really comes in. When you translate that to the stock market, having exposure here, to me what's really standing out is the companies that are behind that big infrastructure push. I'm thinking of Adani, I'm thinking of Reliance. And if you look at it from a biggest kind of a price change point, your two Adani listings are down almost 20% on both of them. From an index weight perspective, it's Reliance. That, of course, headed by the billionaire family, the Ambanis.
Yeah, so we're certainly seeing the fallout from this on those large caps, and there's a lot of read across into those if we don't see Modi as able to deliver on his agenda. Also, though, some of the small cap stocks really under pressure today, and more broadly, the sentiment is, is Modi going to be able to deliver on reform of agriculture, on labour markets, and on capital, and all the areas of reform that he has started? Will that continue if he doesn't have as much?
To what extent will he be constrained? Tata Steel, another one down almost 15%. The relationships between some of these executives and Modi and his government, of course, have been key in terms of build-out and how they've been able to benefit from that policy agenda. So we continue across this story again. Here in Europe, we're looking at losses as well, broadly across the European benchmark of around 0.4%. Here in the UK, the FTSE 100 is down 34 points. The oil majors not helping on that front, down 0.4%. Over in Germany, the DAX is also off by 0.7%. Coming up, airline executives voice concerns over delays in the supply of new planes. We are live in Dubai next, where this year's IATA gathering is being held. I believe we're going to cross over, in fact, to Berlin. It's the air show. Berlin as well.
Aviation
Guy Johnson is on the ground in Berlin. He has been talking to a lot of executives. We have the news, of course, around Airbus selling, at least hoping to sell around 100 wide bodies to China following a meeting between President Macron and Xi Jinping. So we watch that as well. But more on the airline sector after the break. This is Bloomberg.
Demand environment, I think, remains quite robust. It's recovering slower than we had expected, principally because of the Chinese market in terms of international travel to and from China. But I think that's a timing issue, not a plateau.
We're blessed to be in a region that is growing a lot. GCC is growing a lot. I mean, Saudi Arabia is growing a lot. The UAE is growing a lot. India is growing a lot. It's just 3 hours flight, right? Yep. So it's sustainable.
Right now, in terms of engines, we do not have that problem, which the peers or the industry is facing. In terms of aircraft delivery, of course, we face some delays, but which are manageable, I have to say. I mean, it's like several weeks for that.
In the supply chain, we are having trouble sourcing parts for interior cabins, for engines, that type of thing.
We're experiencing more severe turbulence, and we haven't had a significant incident yet, but we are taking all the precautions we need to keep the safety of our customers and our crew to the maximum.
Airline executives at IATA's annual meeting in Dubai, talking about the supply and demand story, but also talking about some of the safety issues with regards to turbulence there. Let's get more on the gathering from Bloomberg's Sid Phillip, who joins us now from Dubai. So the IATA conference has been taking place there then, Sid. What were the biggest themes? We heard some of the executives talking about them just now.
Morning, Anna. So the biggest themes at the IATA conference this year were both supply chain issues, and also we've heard a lot about airline executives talking about pricing and the fact that pricing isn't really going further from where they already are. So everyone's been talking about how there's a high plateau, and that's where fares are going to be for a little while, because it does seem to be suggesting that the consumer don't really want to pay as much anymore to fly. And so airline executives are looking at ways to try and maximize their margins.
And when we talk about maximizing those margins, what does the consumer demand story actually look like right now? It feels like we're getting mixed messages from the data. Are the airlines giving us any insight?
So the airlines have been talking about how demand is still strong. It's just the fact that people aren't willing to pay as much as it takes to get onto a plane. And I think that's sort of the messaging, that revenge travel boom that we saw coming out of the pandemic, and especially last summer, that might not be the case this summer. And we're sort of already seeing carriers like Ryanair and Wizz Air, which weren't really at the IATA AGM, but they have been talking about how they have to stimulate demand with discounts. And that may be something that may be wider spread. But airline executives still sort of talking up the demand story and sort of saying they can't get enough planes, they can't get enough parts for those planes, and as a result, capacity is constrained.
Sid, talk to us about this deal, this apparent deal between Airbus and China. 100 wide bodies being sold by Airbus to China. When are they expected to be delivered? Why is the demand? Why are Chinese carriers looking to take on additional Airbus? Is this a snub to Boeing? What's the COMAC play here as well, their own domestic aircraft maker?
Yeah, there's a lot of factors at play here. So wide-body aircraft have seen a resurgent demand, and that's because long-haul travel is coming back after the pandemic, when basically there was a shutdown. And airlines are now sort of ramping up their wide-body fleets, looking for new aircraft. They're looking to replace older aircrafts, and that's really led to a backlog that's been growing. And now the Chinese carriers are also sort of waking up to the fact that Airbus and Boeing both have order backlogs on their wide-body planes that stretch into the 2030s. We saw that last year with the narrow-bodies, where narrow-body aircraft deliveries were going into 2031 and 2032. And now we're seeing that with wide-bodies. And so the Chinese carriers are looking to replace their older aircraft. They're looking to replace aircraft that have been in service for a number of years. And so they're in talks with Airbus to order as much more than 100 aircraft. And so at the moment, there's a lot of geopolitics obviously at play. I mean, the US and China have a complicated relationship, and that may be a factor in why Airbus is seen as a frontrunner in this deal. But we still don't know what the timing is, when the deal might be announced, what the final contours are. And also, I mean, don't forget, Boeing's also got its own problems with supply chain, and they have to sort of sort out how they can get their 787 and 737 production back on track and actually deliver all those aircraft that they already have in the backlog.
OK, Bloomberg's Sid Phillip on the airline industry, the demand out of China and that backlog stretching into 2030. Sid, thank you very much indeed. Just checking the Japanese yen, a little bit of strength coming through for the currency. Currently up 0.3%. Some lines coming through from the Deputy Governor of the BOJ. On monetary policy shouldn't target FX itself. Monetary authorities should watch FX impacts on prices. Officials out of Japan recently confirming the intervention, of course, that happened last month. There's plenty more coming up. A deep dive on Indian stocks. More details next. This is Bloomberg.
The photo ops are in full swing as the UK general election kicks up a gear. But whoever wins that contest will face a harsh truth. The UK has a massive debt hangover. And that threatens to tie the hands of the next government and to collide with spending pledges on things like defence, healthcare and education.
The UK spent big during 4 years of crises, from COVID to the energy price spike following Russia's invasion of Ukraine. Government support measures during those successive disasters cost around £400 billion. Both parties supported taking a generous approach. Now, though, the bill has come due, with national debt at a level not seen since the 1960s. Servicing that debt in a world of high interest rates is costing an extra £60 billion a year. To put that in perspective, that's equivalent to the entire defence budget without a bullet to show for it.
And now creaking public services are crying out for more funding, with much desired economic growth seeming elusive.
Well, the election debate so far has really been focused on how the parties are funding relatively small pledges on taxes and spending. But this misses the far bigger picture of an unprecedented peacetime rise in debt, rising taxes. What's really happened here is that the fiscal debate has got detached from that fiscal reality.
Rishi Sunak claims the economy has turned a corner, with inflation falling back near the 2% target.
Thank you.
Meanwhile, Labour are on a mission to assure business that they are the party of economic stability. Regardless, the UK faces a mounting bill with no easy way to pay it off.
Bloomberg's Alex Morgan there with a look at the debt issues that face whoever wins the election here in the UK coming up on the 4th of July. It's interesting because in that sense it seems like there's almost nothing at stake because they both face the same problems. But from a political perspective, we could be witnessing a really, really bad outcome for the Conservative Party if what we see in the polls turns out to be true. I mean, we've got the MRP model. It's not even a poll, but it's this MRP model which goes deeper than a poll from YouGov, talking about how the Conservatives could have their worst year since 1906.
Yeah. It's the polls are looking pretty dire for the Conservatives at this point. Of course, they will continue to point out, they would make the argument that the economy is turning around on inflation, on growth. The Institute of Fiscal Studies, this is an organisation you've name-checked as well, Anna, and rightly so, in terms of broadly the picture, the fiscal constraints on any government that takes over after July the 4th, and the fact that they're just not going to have that firepower. The expectation is you're going to have to either raise taxes or cut spending to kind of deal with the debt overhang and rewrite the books here in the UK. And it's going to be a long and painful process for whoever is in office.
So as we get these kind of pieces of policy perhaps kind of rolling out, it feels like there's real complacency in the market, perhaps to your point about that fiscal headroom just not being there. But I'm curious if that just sets up the stage for when the manifesto does properly come out and you see it in its entirety. Is that when we see more volatility?
Is there still room for volatility around this election? Yeah, you do wonder. The Labour Party has been, especially in the wake of what happened with Liz Truss and her administration, the Labour Party very keen to portray the image of not taking too many risks, certainly on the debt side of the UK economy. Is there still any room for that narrative to change as we get closer to July 4th? We'll
and our previous guest, Helen Jewell, saying, look, a hung parliament would be a risk for these markets, and maybe India is a reminder that we shouldn't put too much, or at least we should caveat how much weight we put on the polling, because, of course, you saw this big upside in the equity markets yesterday. These were exit polls, of course, importantly, we're talking about, not the kind of polls we're talking about here in the UK. These were exit polls out of India, but you saw this rally of 3% plus. That has significantly turned around in the session today. Severe drops across the equity markets of India. The rupee under pressure, bonds under pressure, Nifty 50 down 6%. It has reversed some of the heavier losses. You're looking at losses around 8% early in the session, currently down 6%. Similar picture, of course, on the Sensex. Some superlatives as well in terms of how you end the day. 12:30 UK time is when Indian markets close. You could be looking at losses of hundreds of billions of dollars because, of course, the market is so much bigger. And that could be, you're looking set for potentially the biggest daily drop in terms of market cap for India, potentially on record, guys.
Yeah, absolutely. So in terms of where we are on the India story, let us bring into the conversation Shumita Deveshwar, T.S. Lombard's chief India economist, to give thoughts on what's happening in the India story. Shumita, really nice to have you with us. We see a lot of reaction in markets to expectations around this election. We still don't have the result here. What's your early thinking about what the results at this point mean for the Indian economy?
I think as far as economic policy goes, the big risk is possibly increased fiscal spending, because this verdict may be read as one where rural distress and a lack of job creation has hurt the current government. And we've talked about this before, that the lack of job creation, despite India's high economic growth, has been a prime voter concern, even going into the elections. All the opinion polls preceding the elections that began on the 19th of April show that unemployment ranked as the biggest voter concern in India.
And so you're taking you're suggesting then that we don't see a stronger turnout for Modi as many had anticipated, or certainly as he had anticipated, and he set the bar for his own success as pretty high. Shumita, in terms of what, and that's interesting that you talk about rural distress and a lack of job creation, what does this mean from a policy perspective? What are the policies that he would have been able to implement that maybe he'll find it more difficult to implement now if he is constrained, if he's not given as big a mandate as he'd hoped?
I've always said that as far as the reforms go in India, the reform policy goes, that it's always done in an incremental, gradualist manner. I don't see that changing between Modi's, second term in power, or whether he comes back to power in the third term either. I think that, and even if any other government is formed with someone else at the leadership, I just don't think that the reform program really changes much, that it's always done in a gradualist, incremental manner across successive governments. Where, as I mentioned, that I do see the prime risk is of increased fiscal spending, because I think that one thing that the Modi government can be credited with is a fiscal discipline, that, after the surge in spending during COVID, he has managed to bring down the fiscal deficit and has had a fiscal consolidation path marked out. I think that's where we will see the risk, because I was actually on the ground during the elections, traveling through 3 Indian states. And what I found again and again in each of the places that I went to was that people are asking for more from the government because they're not getting enough success as far as their economic lives are concerned. As I said, that lack of jobs and livelihoods are a big concern across vast swathes of India.
Yeah. So potentially a pressure point then on the incoming administration to do more on the fiscal front to support and address some of those challenges. But of course, that raises questions about funding, about the debt markets, of course, and fiscal expansion in India. Shamita, how do you expect the relationship between any Modi government and the RBI to evolve in the months and quarters ahead, and how consequential that could be?
Closely. So I think that India does have a credible central bank, and they have done a good job in terms of controlling inflation. That's been one of the big success stories, in fact, I would say, of the central bank. But if you see things like, the RBI paying the government record dividends, which then, of course, goes into the government programs, even the public sector companies are paying the government dividends. And so these are some of the revenue sources that the government is pulling in and then employing to use as far as its own welfare schemes are concerned. And as I said, I think that, that every political party, even if you see the regional parties that are fighting the elections in states where the national parties are not very strong, everyone seems to be competing with each other as far as, welfare policies are concerned, because, on the ground is just a very different picture than, the high growth rates that we see. So I think that, that this is the way forward for the Indian economy.
Shamita, the story that stands out for me and in terms of this election, the voter demographic, is where the state of Punjab in particular stands. When we're talking about asking for things, when we're talking about getting some of those subsidies and even the employment story, this is a region, for our international audience, we should be clear, that specializes in finance. It's mostly farmland and, of course, has been largely subsidized by the government, but is dealing with a lot of that unemployment story as well, to the point that some of those farmers' protests that you saw in the likes of Brussels, France, arguably in the States as well, you also saw in India Punjabi farmers coming, of course, into New Delhi with their tractors. Shamita, in the context of still higher inflation, higher food prices in India, square the circle for us there. How does that all connect?
So the agricultural sector is the one sector that has really been untouched by any kind of liberalization of policies or reform. And when the government did tend to, the Modi government in its second term, did push through these farm laws through parliament, it saw massive resistance because farmers thought that they're going to lose government protection and that corporates are going to come in and they're not going to be protected against, big companies. And some of that trust with the government was lost. So we saw these massive protests, as you mentioned, tractors basically surrounding Delhi and stopping traffic from moving. And these lasted for a long time, and they were very controversial. And in fact, just before the Uttar Pradesh state election, which is one of the biggest, it is the biggest state in India as far as the number of members to parliament that it sends. Modi actually withdrew the farm laws. He came on national television, apologized, and withdrew the farm laws. So that really shows the tension that that there is this sector, the agriculture sector, that needs desperate reform, where all this rural distress is happening. And yet farmers, because they've been used to government support over so many decades, are unwilling to lose that. And that's where the conflict comes, I suppose, between development and making sure that, that there are enough welfare policies to keep the voters happy.
I love that you mentioned the UP story. It's so important, again, when we talk about just the politics that are at play here. Shamita, I want to ask you about the farming story in the context of the global markets, because Modi has also been very vocal about some of his protectionist policies, especially during COVID times, when some of the rice exports, for example, to the rest of the world were then rerouted to kind of tackle the domestic demand. What might that look like moving forward?
So, this happens all the time. So one of the most interesting stories that I saw when I told you that I was on the ground, looking at the elections, was in Maharashtra, which is a big onion producing state. And as food prices went up, the government came in and imposed all these export controls, and the prices plummeted, and farmers and the wholesale traders were up in arms against the government. And we're seeing that, in fact, play out in the election results, where basically in Maharashtra, the BJP alliance is not doing very well. So these are, every state has its own politics, and at the same time, the government needs to control the prices for products at a national level to protect consumers. But as a result, it leads up, it's like a game of whack-a-mole, that you try and control one problem and another one crops up. So as I said, I think the agriculture sector, it's very difficult to figure out how to reform the sector, which is why successive governments have been unable to do it. And at the same time, all these government interventions don't really play out either.
Okay, Shamita Devashwar, T.S. Lombard's chief India economist, thank you very much indeed for the context and the reform challenges facing the future government of India. Let's check in on the oil markets now. India, of course, a major importer of oil, but checking in on Brent, down 1.1% down in session at $77 a barrel. WTI taking a further hit after the losses and the sell-off of yesterday, $73 on WTI. I wonder if this is a combination not just of OPEC+, but maybe also of the softer data out of the US. But the sell-off continues. Yeah, sell-off continues on oil then, and it took a while to get going, didn't it? The post-weekend sell-off in oil, but it certainly was with us yesterday and with us once again. We're off earlier lows, so we have been down a little bit more than this, Kriti, but energy stocks were down by more than 2% a moment ago, now down by just shy of that.
Yeah, it does feel like it's a little bit of a catch-up trade, because we see so much volatility in copper, so much volatility in gold as well. And even, by the way, in the face of this Indian election that we've been talking about, these markets spilling over, gold has, been relatively complacent, whereas you are seeing, to your point, Anna, that volatility in the oil story. Suddenly, the dollar effect isn't equal among all commodities, which is what we've seen in the last, I want to say, 7 to 10 days in the trade.
Coming up on the programme, we will put some of the social media posts around GameStop front and centre. We saw them yesterday sending GameStop shares surging again, but could the author of those posts get kicked off a major trading platform? We'll discuss that next. This is Bloomberg. This is Bloomberg Markets today. We are 48 minutes into a European trading session that is under a little bit of pressure, down down 0.3% on the 600. The FTSE 100 is down by around 0.5%, and the German and French markets down around 0.4%. So modest losses, perhaps. Some of the US sentiment around that ISM data perhaps weighing, a little bit of focus on emerging market policy risk, perhaps that's weighing. But energy stocks selling off here in Europe. We'll get to that later. But energy stocks are under pressure today, and all of that that weighs on the European session in hand. Let's get to something that has certainly dominated some of the trading in certain areas of the market in recent sessions. The meme stock personality Keith Gill, better known by his Reddit handle Roaring Kitty, could be sitting on a massive payday. He posted a screenshot of what appeared to be a $116 million position in GameStop, which sent its shares surging. But it's led to reviews by the trading platform E-Trade and by the US regulator, the SEC. Let's talk to Bloomberg's Charlie Wells, who's, of course, across this story for us in great detail. Charlie, thank you very much. So what's propelled this rally in this meme stock once again? Is it all about what Keith Gill is doing and what we assume he has as an exposure here?
It is. I mean, it calls to mind not just 2021 when we saw that massive rally in GameStop and other meme assets, but also last month when Keith Gill returned to Twitter and we saw a big rally there. Different month, different social media platform. This time it was Reddit, where Gill was showing that he had this large position. Interestingly, he also indicated that he has 120,000 call options, the right to buy those GameStop shares at $20 later this month. And this just speaks to the fact that, this rally may or may not have legs, but this phenomenon of certain influencers in social media having the ability to bring large crowds behind them, that is continuing.
Some reports reporting out of the Wall Street Journal, I believe, that E-Trade kicking off Keith Gill off of its platform, or at least considering it. This is, of course, the online platform under the parent company of Morgan Stanley. I'm curious how feasible that is, given that... Well, go ahead.
No, it's a really interesting question. I mean, I think there's certainly a debate within E-Trade over, do they kick off someone who could potentially be seen as manipulating markets? People familiar with the matter told the Journal that no decision has been made. But what we know is these brokerages, they do have wide latitude to kick people off their platforms if they want. They can look at a lot of this activity. And what people familiar with the matter told the Wall Street Journal in this report was that they saw a large volume of options purchased last month before that tweet that rocketed the GameStop share price up. So the consideration there is, what is the SEC looking at? But the flip side of that is this market manipulation? A lot of these communications are vague. And of course, there is that massive army of supporters behind GameStop, behind Keith Gill, who could also leave the platform and cost E-Trade customers if they kick Gill off.
Yeah, it could bite back if you click the claws of Roaring Kitty, maybe. How is it that one man can make such a move across these meme stocks? Talk to us about, I'm going to steal one of Kriti's favourite words, phrases, which is market plumbing. The New York Stock Exchange yesterday, another glitch. It's not the first time. A couple of times just this week. What on earth went wrong, Charlie?
Yeah, Tom, so some of those pipes in the plumbing looked like maybe they were kind of, veering in a strange way yesterday. And it was looking early yesterday, like if you wanted to buy Berkshire Hathaway Class A shares, you could get them.
It was a bargain.
Yes, 99% discount. I think they closed Friday at $627,000. They were going for $185. And now look, this looks like a lot of these issues, not just that kind of strange pricing, but also some of the halts, that was related, the NYSE said, to a glitch in software that governs opening price display on a feed that consolidates bid-ask quotes. And this is related to limit up, limit down halts. Now, something a little bit ironic there is those limit up, limit down halts. Those are intended to protect investors against volatility. Yeah. Of course, yesterday morning we saw a lot of volatility. We know that this was ultimately fixed. They were able to revert to a backup data center, and those discounted prices on Berkshire Hathaway, those are going to be canceled.
Yeah, the bargain bucket Berkshire Hathaway trade is not going to pay off ultimately, is it? They're not going to push those through. Market plumbing, why do they do these software upgrades in the middle of the trading day? Why don't they just do it on a sleepy Sunday or something? Charlie Wells explaining the complexities of the market plumbing, the NYSE, and another glitch there. Charlie, thank you very much indeed, and on the meme stocks as well. Here's what else to watch out for today, 3 p.m. UK time. It's the US factory orders, of course, after we got ISM manufacturing coming in much softer than expected, and jolts as well, job openings out of the US. Important on a week when we get non-farm payrolls on Friday. Later, US earnings, including CrowdStrike and Hewlett-Packard, so HP, of course, in the hardware space in terms of technology and IT. Then we continue to wait out, of course, the details around the Indian election. We are getting the vote count, of course, and those continue to ripple through the equity markets, but also, of course, the currency and the bonds of India. We'll keep across that.
Yeah, absolutely. So all things India in focus. Finally, we also had the Berlin Aviation Summit taking place today. IATA was all in focus yesterday over in Dubai. Today, we're all about what's going on in Germany with regards to this summit. We're going to be having some really interesting conversations. Guy Johnson on the ground there, Airbus and Boeing CEOs at this summit. Bloomberg's Benedict Camel will be speaking with the Airbus CEO, while our markets today, colleague Guy Johnson will be interviewing the Boeing boss. That's at 12:10 UK time, 7:10 in New York. You can also watch on Live Go, of course. So plenty of aviation this week, both yesterday and today, as we continue to monitor that. We might get more on that. Bloomberg story earlier around Chinese orders coming through for Airbus, and we know a lot about the travails of Boeing over in China, of course. Kriti, your mind perhaps elsewhere right now, heading off to Super Return.
I am, but also meeting up with Guy Johnson in Berlin. That seems to be where the party is. This is a really important story. We know that Jamie Dimon made those comments, I want to say, 2 weeks ago or so, saying that perhaps the cracks in this market, or the early signs of it at least, could show up in the private credit market. We also know that in this environment, we've been talking about it all morning with the EM spaces, people are trying to find yield. They're trying to find that return in an environment where you're not really getting it in the bond market. It's hard to navigate. So therefore, maybe they're allocating to alternatives. And that's the conversation we're going to be having at Super Return, the largest private equity conference in the world. We have a great lineup. These are just some of the guests that are showing up on your screen out of Morgan Stanley, Goldman, Vista, billions of dollars at play here. Danny Berger will be joining me as well. Apollo, KKR. We've got the whole gambit.
Yeah.
You do not want to miss this coverage.
And a lot of the coverage in recent years was all about the rising rates environment, and a lot of the conversation, the pushback from the industry was, well, look, there's expectations that rates will be cut, and then now, you're going to this event and going to be asking questions about what their expectations really are for rate cuts as the market toys with, well, two, I think we are today.
I'll give the viewers a freebie. I think my first question is going to be, we're seeing so much momentum in the equity market. You're seeing so much momentum in the private credit market. When the party keeps on going, how do you know when it's about to stop? How do you position for that? And, of course, private credit is a very illiquid area of the market, and they're dealing with massive amounts of money. You can't exit it as fast as you can enter it the way you can in the public markets. Another major story or major theme we're going to be keeping an eye on is the fact that so much money is wrapped into private credit. Hedge funds are starting to say, well, how are we supposed to deploy capital into the public markets? Because the same institutions, endowments that are funding private credit also are supposed to be funding hedge funds, and there's a little bit of a liquidity crunch, speaking of market plumbing.
Lot to unpack in terms of the world of PE, and you and Danny Berger will be doing that, of course, on the ground for us in Berlin. Checking on the European markets now, the Stock 600, the benchmark is currently down 0.3%. Here in the UK, the FTSE 100 off by 0.5, down 42 points. US futures also pointing lower modestly, down 0.1%. And one wonders if the non-farm payrolls is the next catalyst, particularly for the US markets.
Yeah, that's Friday, isn't it? We get JOLTS data today, and so any weakness in that job opening story is going to be watched for. That's what Bloomberg Economics is watching for. But to your point, Friday, non-farm payrolls were all about the jobs once again.
I'm so curious about this euro-dollar trade, and Helen Jewell was talking about it, right? It's not about whether the ECB cuts or doesn't cut on Thursday. It's about what guidance they give after, followed by the dollar story on payrolls. Friday's going to be a really fun day for you guys.
Excellent.
Vanguard seeing rates down to between 2 and 2.5% or thereabouts by the end of next year.
Lots to look ahead to then at the end of this week. That is it for markets today. The Pulse is up next. We'll leave them to take you through this slight softness in European equity markets, certainly softness in commodity prices this morning. This is Bloomberg.